TheoTrade. This is Don Kaufman. April 26th, 2023, minutes after the cash close here on this Wednesday afternoon. S&Ps, well, down mildly. Nasdaq exploding to the upside. Russell down big. Look, what you have in front of you right now is a destabilizing dynamic forming in these markets. Let's explain that and much more here on this evening's update. As I was saying, so the S&Ps kind of continue to slip ever so slightly, but I got to tell you, it's right now all about the Nasdaq. What you're actually looking at in this particular case happens to be a 30-day 1 hour, and it's become almost comical, specifically inside of the Nasdaq. And again, it's a 30-day 1 hour because you want to talk about a range. That, people, is an incredibly tight range. It's also an incredibly tight range for the Nasdaq, which is, capable of throwing off 100, 200 point moves on a day-to-day basis. To see that the Nasdaq is, well, trapped from roughly, let's call it 13,000 to 13,200. That's been most of the trade for the entire month. Again, the entire month of April has been in this like 200 point range. We're just breaching it a little bit to the downside and all of a sudden pop right back up. But let me actually get over to the S&Ps for a moment. We have actually, come beneath a critical level. And let's actually go ahead and label that on your screen right now. You know it, you love it. It's the gravity point, 4106. We effectively broke off the 4106, had a little bit lower. Here in the after hours, there's a bid back onto the marketplace, specifically because of the earnings of Meta, which, again, I will discuss here momentarily. But before any of that, I think it's critical to talk about this, as I said a moment ago, destabilizing dynamic, because moving forward, it's all that is going to matter. If you look at the S&Ps today, and you come in here and you say to yourself, it's not that bad of a day. Oh, come on, look, the S&Ps are basically flat. The Nasdaq is up pretty good. A lot of people don't even bother looking necessarily at the, well, I guess you look at the Dow. Some people do look at the Dow, and look at the Russell. Very few people look at the Russell on a day-to-day basis, and you go, all right, not too bad of a day, hanging in there. But this is what I want you to look at first and foremost. Come right here over to Market Watch, and we're actually looking at the S&P 100. Why are we looking at the S&P 100? Take a look right now at the advanced decline line. Now, look, we've all seen horrendously negative advanced decline lines, right? There's 83 decliners, 18 advancers out of the day. So why am I talking about a destabilizing dynamic? Look, right now, the entire marketplace just belongs to tech, all right? What a lot of people have missed in this marketplace is, well, really what's transpired since the beginning of this year. Now, for a moment, I'm going to cruise over to the spiders. I'm going to go to the spiders, and I want to bring up the year-to-date, the percentage returns. And I've talked about extensively in just the last, week or so, how the entire year in the S&P and the percentage returns basically all belong to 5 stocks. It's your Teslas, it's your Metas. I mean, them, again, you love them, it's big tech. But the point that I'm trying to make with this is, you recognize that it's tech that's coming on strong, but did you recognize that the rest of the market, is not only not doing well, that tech is the only thing standing between you and, well, getting annihilated inside of the S&Ps. And again, the earnings in the last couple of trading sessions has only created much more of a divergence. And that divergence, in my opinion, the situation has come to a head. And that's exactly what I want to show you at this point. So if you look at the S&Ps, and the S&Ps right now, are up. And again, if you can't see this on the screen, they're up about 6% on a year-to-date basis, right? So let's actually cruise over and let's take a look at some of the other major sectors. If we look at the financials, all right, interestingly and ironically enough, the financials are down 6% on a year-to-date basis, right? So the S&Ps are up, financials are down. Where's the energy sector? Yeah, the energy sector is basically flat, but literally it's down about 1% year-to-date basis. Between tech, the financials, the energy sector, look, people, there's nothing else worth mentioning. There really isn't. Like you can pull up Walmart all you want. Oh, Walmart's up like 5%. We can look in consumer staples, but they don't amount to anything in comparison to those particular sectors. So what you've got right now is an absolutely wicked, just wicked divergence. And you have to start to ask yourself, like, oh, wait a second. So makes a good point over here because, well, the financials are down and quite considerably, 6%, but they're actually off some of the lows, right? Although we're starting to talk about some regional bank issues again, neither here nor there. The dynamic that's become really, really wild is that if you take a look specifically at the financials, and I'm going to focus on the financials for a moment. The financials to start off the year, all right? I mean, they did fairly well into the end of the year. And starting off the year, oh, they were up here in like the 36 handle, right? That's the XLF. And they've come down quite dramatically, you know, trading in the 32, range. So obviously about a 6% decline. The exact same time, all right? So again, the percentages, they're down about 6%. The exact same time, if we take a look at the energy sector, so now we're looking at the energy sector, jumping from financials to the energy. Energy also kind of sustaining itself, waning a little bit, got a bit under it, but it's starting to drift a little bit lower. Look, we're just not getting any help whatsoever from the energy sector. Meanwhile, if you take a look at the QQQ, the Nasdaq, and or what we term the monsters of tech, look at the monsters of tech. This is just big tech stocks. They're up 31%. But the QQQ as a whole right now is up about 20%. That's your marketplace. And if you start looking specifically at the Nasdaq, you're going to realize the Nasdaq, oh, come on, it's all Microsoft. I mean, it's all Microsoft, which is 23%. But when I say all, I'm actually referencing not so much the percentage returns, the market cap. I'm not telling you anything you don't realize, right? 2.2 trillion. You look at Apple, 2.6 trillion. You bring up now NVDA, which is almost $700 billion market cap. You bring up Tesla, it's almost a $500 billion market cap. Meta's actually above $500 billion now in terms of market cap, and it just jumped after hours, so it's closer now to a $600 billion market cap. Need I even bring up like Google, right? Google 1.3 trillion. Look, it's not just dominant, okay? It's everything. It's just everything. I mean, Amazon, oh, we didn't even pull up Amazon. It's good for a cool trillion, okay? It's basically a handful of stocks. And the destabilizing dynamic is that ultimately, throughout the beginning of the year, the financials, they were holding their own. Now that they've actually fallen 6% this year, okay, everything has shifted to, look, it's all tech. It's all tech. The financials right now, you know, they could rally back up. It's not going to do that much. I mean, it's just not going to move the S&Ps. The market caps of the financials have kind of been debased, if you will. You take a look at the energy sector. The energy sector, it's not a great story right now, but again, their market caps, everything pales in comparison at this point to the big tech companies. The destabilizing dynamic is a very, very simple one, and that is you have the S&Ps. They've been holding their own, and really the entire month of April, they're kind of holding their own. But all of a sudden, we start to slip to the downside. The amazing aspect of this is that we're slipping to the downside in the S&Ps with tech exploding to the upside. And when you start to look at tech, right, exploding to the upside, they are rich at these valuations. I mean, I got to bring up like 3-year charts and you see, all right, I get what he's saying. I mean, this has been a spectacular move in Microsoft's since the front of the year. Just spectacular. There's nothing else you can say about it. Since the beginning of the year, Microsoft, again, now is up 23% year-to-date basis. Take a look at Meta after hours. By the way, Meta's up another 20 bucks after hours, 70%. But after hours here, okay, away we go. This thing just traded from 210 to the 235. It ain't over. Okay, it ain't over. But again, so what's the destabilizing factor? Well, when you start to put this with an advanced decline line, you realize that markets are holding on, okay, like it's grim death. And there's what, you know, standing between you and the abyss, it's 4 or 5 stocks. This is not unlike where we were in 2021. In fact, in late 2021, late cycle 2021. And what I'm referencing on this particular front is, let's go ahead and open up like a 3-year. Right, a 3-year, and you know, we'll use Meta in this particular case. In late 2021, which is pretty much this year right here, tech actually pretty much, you know, ruled the entire universe. In this case, let's cruise over to the QQQ, and you can see it even more effectively in the Qs. The second that the Nasdaq started to fade, the entire marketplace got annihilated. Look, there's always risk in a marketplace, but right now, this wild bifurcation has become a total destabilizing, market force. That's it. It's on right now, and there's not much we can do about it, but you've lost all sense of diversification in this marketplace. That's pretty evident by looking at the spiders and realizing what's actually driving the spiders. I mean, at this point, you have to be fairly amazed that the S&Ps can be up 6% with the financials. I mean, the magnitude of the financials. But the magnitude of the financials doesn't mean anything anymore. As I said, the financials, if they just rallied, for weeks straight, the S&Ps would drag listlessly higher. It's the world according to tech. And this is where everybody turns around and says, well, tech has a lot more upside potential over here. Maybe. But my point is a very, very simple one in context, that tech, generally speaking, has had an amazing run already on a year-to-date basis. And it actually looks much more, like a bounce than a definitive recovery. It's dangerous out there because at this point, we've heard from earnings. Where have we had earnings in here? So let's actually zoom in for a second. Well, still have some earnings ultimately coming in Amazon, right? You still have some earnings coming in where? Apple, which we have to wait for next week. NVDA, still way out in the middle of nowhere. What you have to start to recognize about this is you realize that you're one bad earnings announcement away from seeing the market fall off the edge of the cliff, because you know that financials are not going to save it. Energy at this point, I mean, look, you've already got oil that's rebounded substantially, and started to fade again. Slowing economy over here, that's not going to be an easy sector, to kind of capture the hearts and minds of this marketplace. Right now, again, it's the world according to tech. And I'm not saying, again, I'm not diminishing the fact that tech can rally. It can continue to the upside. It's just at this point, we look to be a very, very late cycle. I think you got to be extraordinarily careful. This destabilizing factor is, just think about a $2.6 trillion company, or even a $1 trillion company against what? You got stuff like Boeing in here. You realize that Boeing was actually up substantially until it faded, but from a market cap perspective, everybody knows Boeing. But the point that I'm trying to make is Boeing's a $120 billion company. It's an afterthought. You realize that a stock like Microsoft, it captured, the size of Boeing was captured in Microsoft today, and then some. So, it's a 7% move to the upside of a $2 trillion company. You put that in terms of like magnitude, it's ridiculous. That's the market cap at the size of almost Costco. That's how big, these stocks have become. And at some point, it's not just destabilizing, it's, this is what can actually cause markets, to hinge on what I term like the abyss. So from this point forward, what you've got here is this, 4106. But what you also have to think about is if we're going to latch back onto the 4106, fine. We'll see how that goes into Thursday or Friday. But I think the more critical factor for the remainder of this week is we are very much outside the edge of the expected move. And markets have kind of rallied up a little bit after hours, but we're hanging on to this. And this is the SPX, like the 4072, like it was grim death. You had about a $62 expected move, but volatility has absolutely picked up, The rest of this week looks like it's going to be volatile, Watch this factor very, very carefully right now, right? So the destabilization is just simply that, you can have now 80 stocks, 83 stocks falling in the marketplace, with the S&Ps barely impacted. But at this point, like if there's one bad apple, if you will, in the crowd, that's all it's going to take to actually slam markets. At this point, in summation of it, risk in the S&Ps is to the downside. Not because we're bearish, not because we see anything technically oriented in the chart. It's because we've seen a rally of 31% in Apple. We've seen a rally of over 70% inside of Meta. We've seen a rally, of, well, all right, Tesla's come off a little bit, but it's still 42%. You've seen a rally of almost 90% in NVIDIA, right? When does it come to an end? And moreover, how much damage is it going to inflict to the S&Ps? Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.